Okay, hello everyone. This is Jeff Foley with Paladin Financial. Thank you for taking time out of your lunch hour to join us this quarter. We have a market update as part of our educational series that we do for our clients. So really do appreciate you taking some time to jump in here with us. We have a special guest here, Mr. Jeremy Bryan with Gradient Investments, that I'll introduce more formally here in a moment. But for those of you that are not too familiar with us, we see some clients that are on here and also some people that we've met with along the way. Just to give you a quick overview of what we do at Paladin Financial, we do comprehensive financial planning, wealth management, investments, and that looks different for everyone's situation. But we have a process of success where all of our clients have what's called a Paladin plan, and that's customized for each person. We have the 5-step process that we go through on the left. The center of all of this is you and your family, and around the outside, those bubbles are things that we address and consider and look at continually through that financial planning process. If I was to simplify all of that into just 3 pieces, thinking of pie, who doesn't like to think about pie? You have your financial plan, your tax plan, and your estate plan. What we want to do is make sure that those pieces are working together. You're not walking out of 3 doors at once, and you've thought through everything possible to optimize what you have as you plan for and navigate retirement. So with that, a couple things and some additional services as we continue to grow as a firm and listen to feedback from our clients on what they need help with. We're also excited to announce that we are offering through Paladin Insurance a number of different services. So Medicare supplements, Medicare Advantage plans, and Part D prescription drug plans. So if this is something that is of interest to you, you need help with this, we cannot reach out to you. You've got to reach out to us. And Nikki Foley, my much better half, is who heads up our services on this area. And her contact information is on the screen. You can email, text, call, and there's also a QR code. If you hold your phone up to the screen and utilize that QR code, that's another way that you can reach out to us, and Nikki will be in contact with you to talk about all of that fun stuff. So encourage you to do that if that pertains to you. So as we dig into today's content, and we're talking about the market, and we usually once a year do a market update, and time again, one of the common things that comes up is a realization that we all need to have that we cannot control everything. And you see on the left here, things that we can control as investors, as consumers, a laundry list of different things. Time in the market, I think, is one of the most impactful things, and Jeremy might be touching on this a little bit in his presentation, but that is a key one. But how are your assets allocated? How are you diversified? Taxes are a big thing. How much you spend, how much you make, and the last one on there is our emotional responses. The market is not a straight line, and we've seen that in the last couple of years. 2022, the market was down a lot. It rebounded in 2023. Doesn't always happen that quickly, but it's very easy when the market is doing what the market does. It's easy for us to want to hit the panic button, sit on the sideline, or we try to read the tea leaves and predict what's going to happen in the future. Things you cannot control, the market being number one. Elections, we have an election year. Jeremy is going to talk about that here in a little bit. Taxes, you have your vote that you can influence some of these things, but you don't have any control over taxes. So understanding the difference on what you can and can't control, and playing with the best way that you can with the cards that you're dealt, and optimizing what you have. So before we jump into our content, Jeremy Bryan is joining us. He's about 40 yards over my shoulder. Normally we do these hip to hip in our conference rooms. We're trying this out a little bit differently here. So Jeremy is one of the portfolio managers at Gradient Investments, which is the money manager that we utilize for the majority of our clients' assets. And he's going to go through a lot of different content here. But Jeremy, I just had a meeting with a couple. I was running a little bit late, getting ready for the presentation here, and I listened to them fight about a kitchen remodel, and it went on, and they kept coming up with counter arguments. So apologize for being late there.
I can hear the office. No, kitchen debates is serious stuff. There's no question about it. So I have, you being the referee in that one, all more power to you.
Thank you. I think I heard our office groan on the other side of the glass here, but yeah, we've got a lot of content. Jeremy's going to be doing most of the talking here for the next bit, And why don't you start off, Jeremy? Tell us a little bit about what Gradient Investments does and what do you do within Gradient Investments?
Yeah, it's a great starting point. So we manage money. I mean, that's really the best way I can describe it. And the way we do it is in multiple different strategies. Because really we want to have something that fits all investors. And usually how this ends up working is we have over 30 different strategies that we employ here. All objective focused, whether that's dividend income, whether that's principal conservation, whether that's all growth. We have strategies that fit a lot of different needs. The real customization comes into play for the clients is working with Paladin and other firms across the country that, where we customize those solutions for you all. We use the proper tools to give you what you need. And Jeff's going to be the leader of that. He will know you better than any time I ever will. My job is to make sure that what we have put forth is what we're actually doing. So that's honestly the most important part of my job, is to ensure consistency with what we're trying to accomplish. And, a lot of times people in my seat can be forecasters, prognosticators, and pontificators. We don't do as much of that. We do some, and we try to understand what's going on out there, but much more my job is to understand what's happening in the markets and making sure what we're doing for you all is consistent with what we've promised.
So your job is not to predict the next market crash, is that?
I'm asked all the time, and I say, hey, no. I wish my crystal ball was better. It's not. It's just as cloudy as everyone else's, but I understand what we need to do when those types of instances occur. That's what my job is.
Yeah, and there's always something lurking out there in the shadows, whether it's China is a common thing that comes up. We have shipping disruptions right now, Ukraine, Israel, a lot of things that could, topple the market at any point. Going back to the slide, we talked about things you can control and things you can't control, and you might want to wait on this and cover this later, but what do you say to people knowing that those things are there and there's always this pending fear of this might be the big one?
It's a fantastic question. And I don't mean to sound glib when I say this, but I've been in this business for 20 plus years, almost 25 years at this point now. My boss, Mike Binger, president of the firm, has been around for 30 plus doing the same type of things that we're doing now. At no time, so that puts us back to 1987 roughly. That's when Mike started. I started a little later. But during none of those times, what we often say is, were there no concerns? There are always concerns in the markets. It's just the degree of concern and the degree of real impact it has. My job is much more to filter out the noise of those things. Is this a short-term problem? Is there something else? Could this be a longer-tailed issue? And if so, who is benefited by it? Who is hurt by it? Understanding those kinds of things is really the most important component of my job, because there's always going to be concerns out there. It's the one consistent. Change and problems and concerns are the one consistent in markets. So we're always going to have them. What we're here to do is try to help you understand what is going on and try to help you understand what we're going to do as a result of it. And a lot of times what we're going to do as a result of it is stay the course with the investment plan that we've put forth. That is, in most circumstances, going to be the answer to give, because we've prepared for these types of things beforehand via the investment plan, via the objectives of the portfolios, and via just knowing our clients. That is a preparation that we make. We do the homework up front so that when these things occur, we are prepared for it already.
Yeah, one of our safe predictions here is that when we're asked what the market's going to do, it's going to change. We don't know when and how and whatnot. We can study all we want, but in the end, there's always going to be something like Ukraine or who knows what that can pop up along the way. But what we can do is have a good plan in place and be steady with that over time.
That is absolutely right.
So the first slide going through this is every year is a little bit different. Can you share with us what's going on in the market as far as different asset classes?
Yeah, for sure. So really, I mean, it's early at this point right now. 2024 certainly hasn't been decided. That's why we have 2023 on here too, because what you had talked about at the outset, which we absolutely agree with, is the market's been a little bit of a seesaw lately, right? 2022 is a really well, 2021, let's even go further back. 2021 was a phenomenal year. 2022 was a really bad year. 2023 was a phenomenal year. It gives people the indication that this is the norm. It is not. Usually it is not the case where we have ups and downs on a yearly basis like this. Do we have years that are negative? Absolutely. But over time, usually it's not a seesaw up and down, no progress type of market. Usually it is a market that in a lot of times can actually be positive for years on end. It happens more frequently, honestly, than less frequently. So in that regard, I mean, this is why we showed this, is that last year, almost everything was green, right? If I had put 2022, if I had left that on there, almost the exact things that are green would have been red, and the only thing that was red last year would have been green. So it's very flip-flop from a market perspective. We're still kind of in that realm right now. You've seen a lot of red, but again, this is early. There is no way that this story is told as of yet. But really what people are doing right now is, again, still flocking towards those large cap US stocks. A lot of what we were talking about last year were the quote unquote Magnificent Seven: Amazon, Microsoft, Tesla, Nvidia, these kinds of names. They really drove the performance last year, and that's continuing in the early part of the market this year. That's probably the biggest story, is that those are still working while other things aren't working so well. But really, we're 6 to 8 weeks into the year so far this month, or right now. This only shows to the end of January. The story hasn't been told. That could revert at any particular point in time, and in fact, we believe that a reversion is probably somewhat likely, just given the source of outperformance of those Magnificent Seven names, that some reversion from the other asset classes could hold up, but we just haven't seen it yet. So we're going to continue to monitor this, but it is really too early to call anything in 2024 a real hardcore trend.
Okay, that's good. So it changes from year to year. It's a good reminder.
So this one I think is interesting, just from what I was talking about before, is kind of that feeling of being on the seesaw. And right now the seesaw is, at a high point, if you will. We're at all-time highs. We have created all-time highs. And a lot of times what we get as a result of that is, well, I'm buying high, aren't I? And that's a problem. Not necessarily. So this goes back to 1988, and it just tells you in the gray bar that if you invested on any day, here's what your return looks like. If you invested, the green bar shows you if you invested all-time highs. Numbers are actually slightly better by investing at all-time highs. The strange component of that is, again, from that perspective, what tends to happen is strength begets more strength. Not all the time. 2021 was a primary example of that, right? We created an all-time high in January of 2022, and then the rest of 2022 was miserable. It can definitely turn the other way, but honestly, it's more frequently that all-time highs create more new all-time highs in the future. So all-time highs and investing at all-time highs isn't, in our opinion, a reason not to invest. And if you think about just very long-term periods, you have to create all-time highs in order to continue to grow. So that to us is not a huge concern. We understand the thought process. We understand the concern that comes out there, but history is a precedent, and just general market conditions would suggest that it's not a reason to avoid investment just because we're at all-time highs now.
Yeah, the challenge comes in that list of things we can control. The last one was our emotional responses. A lot of times we know, lots of charts and graphs on this. People chase performance, they get into the markets high, and we see here that you're showing us if you stay invested, even if it is at an all-time high, the results still come out well. But a lot of times what happens is people chase that high and then the market corrects and they drop out and they lock in those losses. So
that's the bigger concern in that regard, because we are going to have a correction. We'll talk about that in a little bit. It's going to happen. There's no question about it. The question for me, in our component is now the time to be adding aggressively to risk? Probably not, right? I mean, that's not, you don't change it because you're at all-time highs, but on the flip side, it is not a time to get ultra conservative either just because you've hit all-time highs. Again, goes back to doing the homework, understanding where you are and understanding what you need for your money. But from this perspective, it's neither a reason to, it's certainly not a reason to incrementally add to risk, and it's certainly not a reason to dramatically reduce your risk of your portfolios.
Yeah. It comes back to people that are listening. It's what does your personal economy look like? What do you need? When do you need funds? And making sure that as the market does what it does, you have assets set aside that you can use when you need them, regardless of what the market's doing. So
yeah, really, it's what's this for? What's the objective of that? And you're going to know that very well in working with your clients. On the economic side, this chart just kind of shows, you know, really, if you think about, if we had talked about this point last year, the predominant, and I would say it was, I think Bloomberg actually hit 100% of polled economists that said that we were going to face a recession in the next 12 months. All this chart shows is that did not happen. When 100% of economists agree on anything, it's probably looked the other way. I think that's the lesson we should take from this. Not only, you know, so we look at GDP a little bit differently. We look at it as this point right now versus this point last year, right? And so if you look at this, that's this data. What it shows is we actually accelerated. We did not decelerate and certainly didn't go into recession. Our year-over-year growth actually expanded and accelerated throughout the year. Do we expect that for 2024 is the question of the day? No, we don't expect a continued acceleration, but we also, what we're telling people right now is we don't see the ingredients right now for, especially in the short term, a recessionary condition. The reason why I say that, and I'll get into it a little bit more in depth here though, or later, is the conditions usually are, you have a contraction in either the stock market, haven't seen that, we're at all-time highs, and then secondarily, you usually have some type of shock to the job environment. We're hearing a little bit more about layoffs, but still we're nearly 50-year lows in unemployment. In those scenarios, Americans spend money better than anyone else on the planet. And when they have a job or feel like they can get a new one if they need to, they're going to continue to do so, and that's the lifeblood of our economy. That's why we continue to accelerate here, in our opinion, is that the jobs remain strong. That's why we're also saying that it's probably less likely than more likely that we face a recession. Last year, I was flipped. We never say 100% of anything, but we said it was probably more likely last year that we were going to face one. The job market stayed strong. The market stayed resilient. Interest rates did not collapse the economy like there was a thought that it would. As a result, now we're saying there's just not a lot of conditions out there that would suggest recession, but we're going to continue to watch it and see if anything changes.
Okay, good.
Again, I hit on this in jobs, so I won't hit on it hard here, just to tell you that, I mean, jobs are extraordinarily plentiful at this point right now. 3.7% unemployment rate is about, 0.2% away from a 50-year low. I mean, we are very healthy in the job market right now. We're looking for signs. The stuff on the right there, the unemployment claims and the job openings, those are kind of what give us signals that this unemployment rate could change. Now, what are we saying? We think that actually the unemployment rate probably does creep higher. But does it creep anywhere near those prior highs before of 2009, where we had the great financial crisis, or 2020, where we told everybody to go home? Absolutely not. We have no case for that at this point right now. If we think unemployment's rising, we think it rises maybe into that 4.5%, 5% range by the end of the year. That's long-term averages. So even if the unemployment rate starts rising, it's just rising off of very low levels. Now, we don't like to see anyone lose their job, right? I mean, I don't want anyone to lose their job. But from that perspective, we can handle that level of job loss and still continue to be positive in the markets. It could handle that. It's the shocks to the system and the employment that cause people to say, I don't know if I'm going to have a job in 3 months, maybe I'm not going to take that vacation. That's the bigger thing that can create a catalyst for us to actually go into recession. And we're just not seeing evidence of that right now. We're going to watch the job openings, we're going to watch unemployment claims, but there's really nothing there. Even though job openings are falling, they're not falling to a degree where there's, 4 or 5 people looking for one job. It's actually kind of more like 1-to-1 right now. So that's healthy, and unemployment claims are relatively healthy. We don't see any issues of this being aggressively bad right now. And this is why we think we can continue to be resilient.
Okay, good. So inflation is something that comes up a lot in our meetings with clients, and I know you're going to dig into some of the numbers here, but sometimes there's a disconnect between what people experience when they have their grocery cart and they're, you know, walking through the grocery store and putting things in. You look at the price and how much that has gone up. So there's a disconnect sometimes between what people feel and what the numbers in the chart show. So as you go through that, if you could kind of touch base on why that might be.
Yeah, it's a phenomenal question, because when we start to say inflation is coming down, doesn't mean things are getting cheaper. It means they're getting more expensive less fast. So they just get, you know, when inflation comes down, it doesn't necessarily, it hardly ever goes into what we call deflation, which is asset prices are coming down. And to be completely honest, you probably, you know, in food, maybe you want that. In gas, you probably want it. In housing prices and those kinds of things, it's less desirable to have deflation where things are getting cheaper, because then people don't know where to invest in those kinds of things. But so that's where that disconnect lies. I absolutely agree with that and understand it, and saying, you know, my grocery bill is not falling off a cliff. I'm buying the same stuff and it's just as or more expensive than it was before. What it is the rate is changing at a slower pace, which over long periods of time, a general healthy amount of inflation is that 2 to 2.5% range. You can see on that chart on the left, we were doing that for a long time. So inflation just was not a concern for a long time. And it got out of hand for a while, and now it's coming back down to those levels. We're still elevated. We still got a ways to go yet. It is our opinion that 2024, as we roll through the year, this will become less of an issue. This will become more controlled. There will be more evidence that things are coming under control and we're in a more normalized environment. Again, gas will fluctuate. That always kind of fluctuates based upon demand, all the other fun stuff, weather. That can be short-term, very volatile, but other things, other asset prices are getting more controlled to where this will be less of a story going forward. But understand that these things can change. I mean, they're changing both. You know, they change very fast upward and very fast, somewhat downward. We'll monitor it. We'll communicate if we feel differently. But right now, we are still doing the things to get this under control, that we think this will be less of an issue going forward than more of an issue.
One of the things you sprinkled in there, it was a comment about deflation. So if prices did actually go down, we have inflation, but it's slowing. But if prices went the other way and we had deflation, that's not necessarily a good thing. As you touched on, your house is worth less. If you're still working, your boss says, you know what, we don't need to pay as much as we did in the past. No more increases. Social Security, no cost of living adjustment. Pension, no cost of living adjustment. So deflation is not necessarily a good thing.
No, people don't generally, you know, so the quick answer to that is Japan went through a long period of basically no inflation to slight deflation, and their stock market didn't do anything for 20 years. So it's not a great scenario to have deflationary assets. It is more, the best case scenario is controlled inflation. It tends to be, again, in that 2 to 2.5% range, where if we're living in there, we notice price increases, but we're used to that. What happened in 2022 and 2023 is it went to levels that no one was used to, and that becomes very difficult, because then you're saying, well, if this is going to continue to spend, I have to spend more on the stuff I have to spend on. I get less money to spend the things I want to spend on. That's not good for our economy either. So you kind of got to play that middle ground.
Okay, good. Interest rates, another one that's on everyone's lips right now.
Yeah, this is, so the two charts, the next two charts go together, because it's always interesting to me when talking about interest rates, because I always say, which side of the fence are you on? Are you a saver or are you a spender? If you're a spender, interest rates are bad right now. It's not good. If you want to buy a car, if you want to buy a house, you're paying much more for it than you were 2 years ago. No question about it. This is mortgage rates right here. You can see they're coming down, but you were paying 3, now you're paying 7. I'll tell you, that adds a massive amount to your monthly mortgage payment if you're doing that. Now, nice for what saved us from an economic perspective to a certain extent is when we were in that 2-ish to 3-ish and maybe even slightly to 4-ish range, everybody refinanced. So everybody kind of had, or most people had, fixed debt at a relatively low rate, to where as long as you're not going to move, this doesn't affect you at all, right? I mean, you don't care unless you want to move and buy a new house or sell your existing one. it doesn't really affect you that much. You're okay still. You're still paying a relatively cheap rate. Where this does affect is activity in the housing market, right? Is that a person who all of a sudden their monthly mortgage payment on a pending house is 30% more, and they have, instead of looking at a $700,000 house, they have to look at a $400,000 house. They're probably just not buying. Same thing on the other side is if somebody says, my house was worth 700,000, but now in order to fit the payments, I got to be in four. I'm not going to sell my house for that. It just creates a difference of activity. It's not an economic calamity. It just leads to lack of activity. At some point that bow breaks, people get used to higher levels of rates. These level of rates are abnormal in history, but only slightly. What was the real abnormality is that 2 and 3%, right? That's not long-term where the average is. The average is around 5 to 6%. We can absolutely stomach that if it gets to that level. I think you'll start to see some activity rise because there's still a heavy demand for housing among we make fun of the millennials every now and then. I'm a Gen Xer, Jeff, I'm assuming you're the same. We make fun of the millennials, but what we do right now is they are hitting that age where they want to buy a house, right? They want to live in a house, they want to start a family, they want to do that, live that American dream, if you will. They're a big component of our overall base now. They're a heavy population side. So from that side, they want to buy a house. They'll get used to these rates. They'll stomach it. They'll figure it out. And then sellers will come back to the market. So at some point, we see an equilibrium here. We're just not there quite yet.
Yeah. And this conversation on this slide was around mortgage rates. But you have people that have consumer debt, credit card debt. I just heard this week that consumer credit card debt is at an all-time high.
Yeah.
And you couple that with we're in a high interest rate environment, people are paying a lot for that, which is going to impact how much they have left over to put in their grocery cart at the end of the month. So we want that to come down.
Yeah, to a certain extent, what I want to give about that, just 5 seconds on it is coming up and it is at all-time highs, but consumer or credit card debt is almost always at all-time highs, right? Because we're growing more, there's more population. That absolute number tends to kind of just rise over time. What we look at is debt to income levels, and that got super low during the period because people weren't spending because they went home during COVID times and we were getting government money basically, right? And so they were able to pay down a lot of that debt. It's rising back up. The debt to income levels is certainly rising. We're not at red line areas as of yet. And that's why we still think the consumer can continue to spend. Now, what happens is if the job market really does turn south and you have rising debt levels as a result of that, that's where it becomes much more of a problem. People have to cut back and you get a recessionary conditions as a result.
Yeah, that's good.
Turning to the other side of that coin is what I like to talk about for savers, is for people who are using this money, who have a pile of money sitting there and want to earn some interest on it. Most people, as you know, 2-3 years ago weren't getting much, right? If you bought a 2-year treasury in January 2022, you're getting 1.16%. Great, that's not really doing much for me. At same risk level now, the same 2-year treasury now for a saver is 4.22%. Just significantly higher. It just changes the argument about how much return I can achieve in retirement because I've been a saver, I've saved my entire life, and now I'm going to use some of this for spending, but I'm not probably going to massively increase my debt load, at least hopefully. But what I am going to do is utilize this, but I'm getting a higher return for those relatively safer assets. So again, interest rates aren't necessarily, rising interest rates aren't necessarily pure negative for everyone. Took a lot of pain for the bond market to get here to that reset rates. I mean, bond prices have been pretty bad for the better part of a couple of years. But as a result of that, people buying now are just getting much higher interest rates as a result of that. And so there's just much more opportunity. That's a good thing for the saver side of the interest rate argument. So I just always try to show both of those sides, is that this isn't always massively negative because now we have the opportunity to actually get some return without taking massive and inordinate amounts of risk.
Yeah, another thing too, the rates are paying, much better on high yield savings accounts and CDs, and that will start to come down over time. Yes. But even at 4%, 5%, if inflation's at 5%, you're breaking even from a spending power perspective. And then if that money is in a taxable account, you also have to pay taxes on that 4 or 5%. So you're going backwards.
Yeah.
And it's not to say that those tools shouldn't be used, but we want to look at the big picture of what are my needs, what's my risk tolerance, my allocation overall, and take advantage of these things. And we've helped our clients to do that over the last year or two, but don't get lost in, well, now I'm making 4 or 5%, all is great. You don't want to put all your money in.
Yeah. You hit the nail on the head with one thing there, which is it's a tool, right? The tool, you don't use a hammer for a screwdriver, right? Cash components are great for near-term savings, for upcoming expense needs where you don't want to take a lot of risk. That's what cash is designed for. It's a great asset for that. Long-term returns, under almost all scenarios, cash is probably your worst performing asset. So you don't eschew everything. I mean, the ideal example is last year cash was paying 5% and everybody was like, great. Stock market did 27%. So I mean, it was just, it's a massive differential in that regard. And so you don't get rid of everything just because cash is paying you a little bit more. But what you do understand now is you're actually at least getting something for relative safety. It doesn't mean you go all into safety because, again, as you said before, you have inflation and taxes that you're going to have to answer to. And cash really doesn't help you out in that regard that well.
Yeah, it's good.
Okay, earnings growth. So I'm going to turn to the stock market here a little bit in the effect of, if you've ever heard me talk, you've probably heard me say that this is the thing we follow the most, is because if you look at very, very long-term charts over longer periods of time, if the S&P 500 earnings are growing, the stock market's probably growing too. Does it happen every year? Absolutely not. Primary example is 2021 to 2022. 2022 earnings actually grew. Stock market was terrible. Last year, 2023, we were basically about flat for earnings, and the stock market was phenomenal. So on a year-to-year basis, you can't use this. But over longer periods of time, if earnings growth is good, chances are the market is going to probably be okay. And here's what we see right now is that 2024, 2025 are showing relatively strong earnings growth. What I will caution you on is I think this is probably overinflated. I don't think we're actually going to grow 11.4% this year. That's the consensus expectation. We think it's probably more to mid high single digit growth. Again, absolutely fine. What you'll probably see is a normalization of that over a longer period. You start to see those numbers kind of crest out, maybe come down a little bit. Usually doesn't lead to massive amounts of negative performance in the stock market unless those expectations go from very high to very low to potentially negative. That's what you want to watch a lot out more for, and we don't see a scenario for that. We think their estimates are probably just a little high right now, and they always are early in the year, and they figure it out going forward. So no real red flags here, but just understand that that growth is probably over exceeding what I think we'll actually do.
Okay.
This is the one where if you want to call something I certainly wouldn't call it a red flag. It's probably more yellow and maybe even orange at this point right now. And the reason I say that is this is valuation, or basically what you're paying for the market, the price you're paying for the market. And this, you can take this back very historically. We look at 5 and 10-year averages. We're above that level right now. Now, does this mean short-term calamity in the markets? Absolutely not. You can't use valuation for a short-term market signal. Expensive can always get more expensive, cheap can always get cheaper. What this tells you better is your long-term return trajectory. At times when the markets are cheap, you can probably expect above average returns. At times when markets are relatively expensive, it probably suggests that the next 5 to 10 years are probably slightly below average. And we're at elevated levels right now. We're above 5 and 10-year averages. So from that perspective, what I would say is this is not saying the market is due for a 20% correction in the next 6 months because we're expensive. Absolutely not. But what I would say is maybe 8 to 10%, which is long-term market averages, might be closer to 6 to 8% over the next 5 to 10 years, right? And most people say, well, I can stomach that. And the other thing I would tell you is that this can change relatively fast, right? If we do have a 10, 15% correction in the markets, which can happen, right? It can happen from time to time. The valuation changes pretty quickly. As long as the earnings aren't falling off a cliff, they get cheaper. So this can change relatively quickly. That's why we monitor it. But if you're using this as a buy and sell signal, you probably got better avenues to take than doing that, and I wouldn't recommend it.
Okay. This is perhaps one of the biggest ones in here with the election year. Common question that comes up is what's going to happen with the market? We have the election and this person or that person's going to topple things. What's been your experience, and what do you see on the horizon with this?
Yeah, I like to start with, I think this is always the good baseline assumption is market, politics, and portfolio, or excuse me, politics and markets and portfolios don't tend to mix very well. This shows the S&P 500 over a long period of time. The common tying bind here is red or blue. Blue is, Democratic, red is Republican, excuse me. Both tend to work. Both tend to work fine. It is not dependent. I know 2024, I know you're going to start to hear more and more and more about this. Try to not make emotional decisions based upon what your politics are with regard to what you're doing in your portfolios. Here's the reason why I think this is valid, is that over long periods of time, there's two things. One is that long-term markets are much more conditioned on earnings growth, which we talked about before, which are based upon company actions. We invest in companies. We don't invest in politicians. Companies, and especially in the US, this is my opinion, is that I think the US companies, they're most efficient and adaptable companies in the world. The reason why is if they are not, they will go out of business. It is that simple. Somebody else will take their spot. They have to be efficient and adaptable. That's what I rely on. And so when political winds change, there might be some disruption. There might be some differences that they have to do. There might be some new companies that sprout up and some other companies that fail as a result of that. But overall, that adaptive engine of the US economy is what tends to drive long-term performance and why I think this trend continues over longer periods. So we don't get into the forecasting game. We don't say, we think this person's going to win, and then as a result of that, this, and this are going to happen. It's, to be completely honest, somewhat of a fool's errand. The other component of that is you got to get two things right. You got to get the political action right, who wins and what happens. You also got to get the market's reaction to that right. And those can be two vastly different things. So we just don't think it's a game worth playing. So what will we do during this political season is we'll continue to provide content around our thoughts on what's going on in the markets, and also our thoughts on as things get changed. If we see a change, we will tell you, hey, here's who we think benefits, here's who we think is hurt by these types of things. But we are not going to dramatically shift portfolios based upon prognostications of political environment. One, it's fraught with danger. Two, I don't think we're very good at it, nor do I think anyone is really good at it. And three, it doesn't really create a lot of value. So we're just gonna, for the most part, not do it. We understand the concerns completely though. So we will answer any of those questions that come as a result of that. Just understand you're not gonna see a lot of action that comes as a result of our portfolios based upon what we see in the political environment.
If you look at companies like Amazon and they're sitting around the boardroom and there's billions of dollars that they're deciding what to do with, and they're planning and all the stuff that goes into that, companies like predictability, they don't like the unknown. So how does that tie into what we see happen in the, who's in the office and what's happening in Congress and so forth?
Yeah. It's ironic because typically business likes status quo, and they honestly like gridlock to a certain extent, right? Because they know there's no massive political shift as a result of what is happening, which could cause some dislocation, right? So gridlock is actually not that bad for them. They actually relatively enjoy that. The other question I get a lot is, and it depends on either side. It's usually the other side is bad for business, or this side is bad for this, or this side is bad for that. If you look at market conditions under different political circumstances, whether it's a Republican-led Congress and president, whether it's mixed, or whether it's a Democratic-led president and Congress, all of those scenarios are positive. What may surprise you is the one that's actually performed the worst is Republican and Republican. I don't think it has anything to do with the politics. I think it's much more circumstance. I don't really believe that that is a driver either way, but all of those scenarios are fine. And actually the most profitable scenarios are those mixed bags. Again, over long periods of time, politicians, if they get, as long as they're not distracting business aggressively, again, and allowing markets to work over an extended period of time, in my opinion, businesses will survive and will thrive, because if they don't, someone else will. And so that's our job, is to understand who is helped, who is hurt, do those kinds of things, and not make, oh, if this is a fully Republican-led thing, we can expect 3% return as opposed to 8% return if it's all down. I think those numbers are largely noise. I think much more concerning is what the companies are going to do over longer periods of time.
A gem in there, I think, is allow markets to work. Someone should write a book about that.
Right. Yeah. Exactly right. Turning to this slide, just because the next question I'm asked is after the political environment and all that stuff, do you see a correction happen in the markets this year? My answer is yeah, I do. And the reason why is it happens almost every year. So this chart, it can be noisy, but it's really simple to understand. The gray bar is the top to bottom performance in one particular year, the worst component of that. The red bar is the end of the year performance. So you can see we always have 5, 6, 7, sometimes 10, 12% corrections, even in very strong markets. The other thing you can see is, again, we've been on that seesaw, right? 21, very strong, 22, very weak, 23, very strong. We'll see about 2024. But look at prior history going back there. There is not that level of consistency. 1 year up does not mean the next year down. And so you tend to run in streaks more frequently than you do. Again, market's up 73% of the time anyway. So chances are generally they're in your favor to begin with. But just because we've had one really strong year does not mean we have to have a negative year the following year. I know that's the recent pattern, but it's not the case over longer periods. But we are going to have a 5% correction at some point. We're going to have a 10% correction at some point. We're going to have a bear market again at some point. I don't see that happening anytime near soon, but could happen, certainly. But we are going to have those correction environments. So just understand that this is a normal part of functioning markets, but over longer periods of time, staying that course, as you said before, is how you're going to make your money in the market. And this just brings that home. Now, I've got a new little tidbit on here that I really like to kind of reflect, because again, longer time things are in your favor, which we've shown that many times via the percent of positive years is almost 3/4 of the time market's positive. The other one now is here at the bottom. So if you count just red and green, I think we can all count, even I can count, the number of all down years that are in red. I don't care if it's down 0.1% or 50%. The number of all down years is 26. The number of 20% or greater years of return in the stock market is 37. So statistically speaking, just going back over a long period of time, you are more likely to have a 20% plus year than you are to have any negative year at all in the stock market. I think that reflects, again, staying the course, the odds of being positives, time in the market, not timing the market, because you don't know which one of these on a yearly basis is going to be green versus going to be red. You have a much more higher likelihood the longer you can stay of having much more green, and significantly more green than you do in red at all. So this I just try to use and bring home about what you said at the outset, things we can control and things we can't control. We cannot control the year-to-year performance of the stock market. I will not pretend that I can do that. But what we can do is say, based upon our objectives, if we stay the course here, more than likely we will have positive outcomes as a result of it, rather than severely negative outcomes.
It's good. Yeah, I hadn't seen that wrinkle before, the 20% plus. It
just brings it home. It's just a very interesting component of the markets that people don't think about very often is, oh, I'm more likely to be up 20 than I am down at all. It's pretty good odds, right?
Yeah, that's good. So thank you, Jeremy. A couple other things before we wrap up, but really appreciate your insight, expertise, and everything that you do for us and our clients. Appreciate your partnership. So thank you for taking some time to join us here. Before we wrap up, for those of you that are not clients of Paladin Financial, We offer a complimentary second opinion on your plan, whatever that looks like. And maybe you've never looked at this stuff before and avoided it, or you have a plan in place. We can offer you a complimentary second opinion on what you have today, and how do you optimize, again, the resources that you have, your income, your assets. What do you do in your situation? All the boxes that you see on the screen here are things that we look at as part of that second opinion process. If you're interested in that, there's a QR code. I'll have our phone number up here in a moment, but typically there are 2 meetings as part of this process. The first meeting, we ask you a lot of questions, we gather information. It's usually 45 minutes to an hour long. We can do that through Zoom or in our office, and we schedule time to get back together 2 or 3 weeks later. And between those meetings, we've gone into the lab and evaluated what you have, come up with recommendations and strategies to help you to get the most out of what you have and answer any questions that you have. Retirement, Social Security, tax minimization, whatever that might be. And at the end of that second meeting, you decide, this is great, what do we do now? No, thank you, I'm going to keep doing it myself. No, thank you, I'm going to continue to work with my other financial professional, or I want to think about it. But we've done our work to provide you that second opinion, and we put a lot into that. I've never had anyone look me in the eye and say this was not worth the time that we went through that. So you're going to get something good out of that regardless. So reach out to us if you'd like to schedule that. I also want to share with you, we are involved in a nonprofit foundation called Gradient Gives Back. So Jeremy's company, Gradient Financial, offers this program that we're able to participate in. And through this, we will help fund a family for up to 12 months of lease or mortgage payments. And so if you know someone that is in a situation where they need a hand up, have them go out to our website for this. You see paladingivesback.com, or use that QR code. There's an application process. Again, it's a nonprofit foundation, but we're looking for a family to support in their time of need. Our office, we're located 40 yards from Jeremy in Arden Hills, corner of Lexington and County Road F. Highway 694 is about half a mile away. You can call us, text us, email us, and we look forward to getting together. So I hope this was helpful for everyone, to give you a quick update on the market. And who doesn't love a presentation with a lot of charts and graphs in it, and a dad joke to boot. So thank you very much for joining us, Jeremy. Again, thank you for your time, and everyone have a lovely afternoon. Take care.